Welcome to Mining in Difficult Markets, a discussion of U.S. legal issues for mining companies and advisors, presented by Dorsey and Whitney. And I'm Kimberley Anderson, and I, along with these three guys, are all in Dorsey and Whitney's Canada Practice Group. Yes, and so Chris Doerksen, Ken Sam, and Dan Miller. Chris is in our Seattle office. Ken, as you can see, is in Denver, and Dan is in our Vancouver office. We all work in the Canada Practice Group. We all variously do public company reporting, corporate finance, as well as mergers and acquisitions. But before we start, I want to give, for our New York listeners, the New York CLE code, which is QXK269. And I will be repeating that later on in the presentation in case someone's joining late or you just want to confirm it again. So Chris Doerksen is going to start us off with a discussion of capital markets transactions.
In today's market, many mining companies are struggling with how to raise capital. Some good news is that effective September 23rd, so less than 2 weeks from now, the securities laws governing U.S. private placements are being revised in what's arguably the most significant way since the 1980s to allow companies to market their offerings much more broadly and more freely than ever before. I'll tell you how and what conditions were imposed on issuers that want to do this. I'll also tell you about some other amendments and proposed changes that will affect how these kinds of private placements are undertaken. The two exemptions that are affected are Rule 506 of Regulation D, which is often known as the Accredited Investor Exemption. And the second one is Rule 144A, which is a resale exemption for resales of securities to qualified institutional buyers, which are sometimes called QIBs. These two exemptions are the most commonly used exemptions for broadly marketed private placements in the United States. But before we get into what the changes are, let's just do a quick recap on what exactly these exemptions are. So first, Rule 506 of Regulation D is an exemption that generally covers sales to accredited investors, which are basically wealthy individuals as well as entities that have significant assets. There is an ability to issue securities to people who are not accredited investors, but that's very seldomly used because it has significant additional disclosure and other requirements associated with it. Shares that are issued under this exemption are restricted securities. They're required to include a legend. The issuer is required to file a notice on Form D with the SEC. The states are prohibited from imposing any additional restrictions, but they can require filing and the payment of a fee. And one of the key concepts that has always been in place here is that issuers could not do any general solicitation or general advertising, which is just a fancy way of saying you could only contact and solicit investors that the company or one of its insiders already had a pre-existing relationship with, or you had to go out and hire a brokerage firm that had those relationships, and then the brokerage firm could solicit that kind of person. Next slide. The other exemption, Rule 144A, as I said, it's a resale exemption to qualified institutional buyers, which you could consider to be super accredited investors. This exemption is usually used in underwritten deals because it's a resale exemption. State law is not preempted, but the states generally have roughly equivalent exemptions anyway. Next slide. Now, what's changing? So last year, the U.S. Congress passed the Jobs Act. One of the things in the Jobs Act was an instruction to the SEC requiring the SEC to remove the restriction on general solicitation and general advertising on Rule 506 and 144A offerings, as long as the sales were limited to accredited investors or QIBs and reasonable steps were taken to verify that. Issuers are not required to use these new rules. You can continue to rely on the old rules if you prefer, but if you'd like to try out the new rules, here's some things that you could do. You could issue press releases that talk about your offering. You could use your press releases to generate investors. You could advertise your offerings on the company's website or through TV, print, and internet ads. You could cold call investors that you don't have existing relationships with. You could directly market your offerings at mining investor conferences, including potentially having your subscription materials at your booth and trying to sign people up to your deal at your booth as they walk by. As you can see, there's a lot of possibilities here. If these new rules begin to be broadly adopted, you could see companies behaving in very different ways than before in their public communications. The catch is, if you do this, it's not good enough to have the investor just check a box in the subscription form confirming that it's an accredited investor or a QIB. You need to go a level deeper. The SEC didn't tell you what you need to do to qualify as taking reasonable steps, but they did make a short list of things that would be considered reasonable. The first, and the one that I think is the easiest, is third-party certification. It will be acceptable for a U.S. registered broker, a U.S. registered investment advisor, a U.S. licensed attorney, or a U.S. CPA to sign a certification that the person is an accredited investor based on reasonable diligence that they had done within the last 3 months. Other safe harbors that the SEC said would be good enough, which I think are more difficult, are actually obtaining tax forms from tax filings from the investor, their bank statements, pulling credit reports, things that are a little bit more invasive. The SEC also adopted a grandfathering rule that does not require this deeper dive when you're dealing with an investor that the issuer has already issued securities to in prior transactions where you know that that person is already an accredited investor. Next slide. A few other things to keep in mind as you think about whether your company may want to try to rely on this exemption. First, the new rules don't take effect until September 23rd, so you've got to wait nearly a couple of weeks before you can start doing this. Second, the SEC has a concept that you may have heard of that they call integration. And the idea here is that if an offering occurs within 6 months of another offering, they might be considered by the SEC to be part of the same offering, in which case all of the offerings need to comply with the same exemption. Basically what this means is that you're not going to be able to willy-nilly choose, flip back and forth between what approach you want to use, the old one and the new one. You're going to have to pick one and stick with it until you have a significant period of time where you're not offering securities. Third, brokers will have their own views. The brokers that we've talked to have generally said they have no plans to be early adopters on this. Fourth, there's no backup exemption here if you try to do general solicitation and then you fail to take reasonable steps to verify someone's status. There's no other exemption that allows general solicitation. So if you do this, you're going to have to make sure that you do it right. So taking out my crystal ball, here's what I think what will happen. Brokers won't be early adopters, but a lot of companies, particularly the smaller ones that are struggling right now and are trying to get a non-brokered offering done, those kinds of companies will realize that this may be the way to get their word out, to broaden their investor pool and stay alive. So they'll start doing it. Once they start doing it, it will be a little harder to stop because of the integration rules I mentioned. After a while, people will get comfortable with it and it'll be more used. But its use by bigger companies, I think, will continue to be limited by the desire of brokers, investors, and really everybody to get deals done with as little paper as possible. And when you do this, you will require more paper. Next slide. At the same time, the SEC has added new rules that will disqualify certain companies from doing private placements in reliance upon Rule 506 of Regulation D. Now, just to be clear, this disqualification will apply to all offerings under this exemption, even if you want to continue to rely on the old rules. The disqualification does not, however, apply to other exemptions like Rule 144. The disqualification, effective September 23rd, will apply if any of the issuer, its predecessors, its affiliated issuers, which basically means subsidiaries and sister companies, its directors, its executive officers, any other officer that's actually involved in the offering, any promoter of the company that is still associated with the company, any 20% shareholder. If any of those list of people have had certain U.S. convictions, orders, or judgments against them, those companies will no longer be able to do offerings in reliance upon the Rule 506 exemption. There's also a disqualification if a company that would otherwise be eligible pays a commission to a broker or a finder that itself is disqualified. And on the broker and finder side, it applies to the broker, the finder, any of their directors, any of their executive officers or officers that participate in financings. There is a grandfathering rule, so if one of these events has occurred prior to September 23rd, the exemption is still available, but only if you disclose that disqualifying event to the investors a reasonable period of time before the sale. So the takeaway on this new disqualification rule is it'll be important for all issuers that plan to issue securities in the U.S. under this exemption to get D&O questionnaires out, get them out to your directors, officers, any 20% shareholders, any promoters, confirm whether people have any of these disqualifying events, then look at your company's own history, the history of your subsidiaries, find out if you're disqualified or not, and make sure that you include the requisite disclosure in your offering documents if it's something that would have been a disqualifying event but it occurred before September 23rd. Dorsey has developed a questionnaire form for this that we're in the process of rolling out to clients. If you haven't received a copy of that from us yet and you would like a copy, feel free to contact either me or any other of these the corporate presenters today, and we'd be happy to send you a copy. Next slide. Lastly, the SEC has proposed some additional rule changes. These are simply proposals at this point. They have not been adopted. The market reaction has been negative so far, so it's not clear whether these changes will be adopted. But just so that you're aware of what they are, the proposals include additional Rule 506 disqualifications if an issuer simply fails to make a Form D filing entirely. The proposed disqualification would also apply for a specific period of time if you are more than a month late in making a filing. There's also a proposal to require annual and final amendments to a Form D if an offering is continuous. And then there are some proposals related to the new general solicitation type of offering, including having to file a Form D 15 days prior to your first general solicitation, having to put special legends in any written communications that you use in such an offering, and then a proposed temporary rule that would require issuers to submit copies of their written offering materials, and that's intended for the SEC to see what people are actually doing under this rule. Again, the things on this page are just proposals and may not be adopted. Well, this is the end of my section. Thanks for listening. If you have any questions regarding these new rules, feel free to contact me or any other of the corporate presenters after this session. Now I'm going to turn things over to Ken Sam, who will talk about the other ways in which we're seeing mining companies raise money in today's climate. as things have really changed a bit in the last year.
Good morning. Again, Ken Sam, partner in our Denver office and member of the Canada cross-border corporate group. Generally, mining companies fall into three broad categories: junior exploration stage companies, the mid-tier companies, which are companies that have near production or in production projects, and then the majors. Majors are producers, normally with multiple properties and long histories of production. The recent downturn, after a pretty good run for 10 years, has impacted all three categories of mining companies. E&Y published its first half report on mining companies for 2013, and there's some interesting facts that may or may not be apparent. For junior exploration stage companies, those are companies that are, again, trying to raise money for general exploration purposes and generally are active in the IPO market to the extent that there is one. During the first half of 2013, there were only 12 IPOs to raise a total of $459 million. That's less than half of what was raised in 2012. And then in terms of follow-on financings, there was a total of $2.9 billion. The interesting fact is the average raise on a follow-on was only $1.6 million. So you see that the size of the offerings have decreased fairly significantly. KPMG published its first quarter newsletter, and just to demonstrate how the equity markets have been punishing companies in the mining space, the equity indexes for mining companies fell 10% more than gold and copper prices. And M&A activity has fallen for 4 consecutive quarters. That's pretty telling for companies in this space. For mid-tier companies, they have traditionally relied on both follow-on financings in the equity space, as well as traditional lenders who will loan for projects using project financing on proven assets and management. There's been an increase in streaming, royalty, joint venture, and takeoff agreements. And then we're seeing a resurgence in the convertible debt space. For the majors, there seems to be a shift from equity financings, and we think this is due to the lower valuations. And we're seeing several high-yield bond offerings. In the first half of 2013, approximately $50 billion. But there is a tightening market both in the bond space and the equity space. We're seeing shorter terms. We're seeing issuers, the majors, cut their dividends, and they've also been taking significant write-offs on properties and assets. And there's been some questionable valuations in the M&A space, and that's forced them to take write-downs. And of course, the weaker commodity prices have all impacted mining companies. Chris talked briefly about, or he explained, the primary ways that mining companies raise money in the U.S., and those are generally done through private placements. The two exemptions are Rule 506 and Rule 144A for raising money in the U.S. Outside the U.S., just to recap, is Regulation F is the exception that's generally used for offshore transactions. So these are offers and sales of securities made outside the U.S. To non-U.S. persons. Generally, Reg S requires no directed selling efforts, and that is generally akin to general solicitation or advertising, or activities that are designed to condition the market in the U.S. So you're probably wondering, how does this work with the Jobs Act in light of the fact that the SEC has adopted rules that will become effective that permit general solicitation and advertising in the U.S.? Well, the SEC has provided an interpretation that says basically, to the extent that you follow the safe harbors under Rule 506 or 144A, you will not be deemed to be engaged in directed selling efforts. That being said, there are generally three categories in which an issuer will fall into in order to rely on these exemptions. The first category is for foreign private issuers. Those are issuers that are incorporated outside the United States and generally meet specific requirements for shareholders resident in the U.S., their assets, their officers and directors and principal offices. If an issuer meets the definition of foreign private issuer and has no substantial U.S. market interest, in other words, their primary trading market is outside the U.S., then that issuer can rely on Regulation S and issue unrestricted securities. This is the most common category in which foreign issuers fall under. Category 2 issuers are those issuers that are foreign private issuers and they do have a substantial U.S. market interest. So they may be trading on NYSE or NASDAQ, and there's significant volume in the U.S. Those issuers are required to impose a 40-day distribution compliance period designed to prevent flowback of those securities into the U.S. markets. The final category of issuer is Category 3. And Category 3 issuers are basically U.S. domestic issuers. They basically follow the same protocol as any issuer issuing securities into the U.S. The securities that they issue are restricted securities, and they're subject to a one-year distribution compliance period. As I said before, except for certain issuers or transactions, most transactions are done on a private placement basis. Occasionally, or under certain circumstances, an issuer will file a registration statement with the SEC. Along with filing a registration statement with the SEC comes 34 Act reporting consequences. Normally you see companies that are listed or that have significant U.S. market participation in offerings go the route of filing a registration. So basically a registered offering is a U.S. public offering. Registration statement is filed with the SEC. Sometimes the registration statement is specific to an offering. Other times it's a shelf registration in which an issuer files a shelf and is able to draw down off the shelf and sell shares on a registered basis. The structuring of registered transactions is pretty varied and most common both in Canada and in the U.S., where you see a firm commitment type offering or underwritten offerings, very similar to a bought deal in Canada. Sometimes you see marketed transactions, which are done on an agency basis, and sometimes there's a hybrid transaction in which you confidentially market to certain institutional investors. You bring them over the wall, they sign confidentiality agreements, and then a drawdown is done off the shelf. Another type of offering that we see very seldomly, but sometimes we do see them, are at-the-market transactions. And these transactions are basically done with an agreement with a broker and sold off of the shelf at the direction of the issuer into the marketplace. Whenever a registration statement is filed with the SEC and you're conducting a registration a registered offering, the securities are unrestricted securities. One thing to note is if you are listed on a U.S. exchange and also exchanges in Canada and elsewhere, you need to check what listing approvals are required. Sometimes there are exceptions for pricing discounts if the offering is done on a public basis. In most cases, underwriters will require 10b-5 letters, so there's a significant amount of due diligence on the disclosure materials. And finally, in some instances, underwriters will be required to file FINRA filings related to the compensation that they receive. One thing to note is that for companies that have active markets in the U.S. and that are already reporting with the SEC, a shelf registration statement is often viewed as a good idea. It provides a quicker way to the marketplace if you need to do a registered offering because they're generally not subject to SEC review, and you can act quickly if need arises to raise capital. Next slide. In difficult markets, sometimes it's better to reach out to those that you know when you're trying to raise money. And rights offerings are designed to do this, and many times an issuer or a company is able to have a rights offering backstopped by a major shareholder. The other thought about rights offering is because the rights are being offered to shareholders, the effect of dilution is probably less harsh on shareholders. At least that may be their view. So again, rights offerings or equity offerings to existing shareholders. Any offer and sell of securities into the United States either needs to be registered or exempt. So there are a few ways in which you can do an exempt rights offering in the United States. One is under Rule 801. It's an exemption for foreign issuers which have less than 10% of their equity held by U.S. shareholders. In order to rely on this exemption, you file a Form CB with the SEC, and you file a Form FX, consent to service a process. This doesn't require an issuer that is not already reporting to be subject to SEC reporting obligations moving forward. The Form CB is basically the document that you use for your rights offering outside the U.S. It has to be done on similar terms to U.S. holders. In some very limited circumstances, we see rights offerings done to pre-approved accredited investors in the U.S. and foreign subscribers outside the U.S. This is done on a very limited basis, and you should consult one of us if you have questions about when it's appropriate to use this structure. Again, you can register the offering. For MJDS, or multi-jurisdictional disclosure system filers, those are Canadian issuers, foreign private issuers who have been traded on the TSX or TSXV for 12 months and have a history of continuous reporting in Canada for 36 months. They can file what's called an F7 registration statement, and the result is the rights offering is registered, and there's no ongoing reporting obligations for the issuer. The other SEC forms, an S1, F1, F10, and S3, all trigger ongoing reporting obligations. It's important to note that usually U.S. standby purchasers are treated as receiving restricted securities in connection with the acquisition. Next slide. We're seeing a resurgence in convertible debt financing. They were popular 5 to 10 years ago. Many of them became due and needed to be replaced. But given the tight markets, issuers are looking to this type of financing again. So what are they? They're generally placed to QIBs in the U.S. Those are institutions with more than $100 million under management. Debt security has to be repaid. It's usually subordinate. And if the issuer is traded on a national exchange in the U.S., the conversion has to be at least 10% premium in order to qualify for Rule 144A. There are fewer restricted covenants compared to high-yield bonds in banks, bank financing. Maturity is usually more than 5 years. I understand that's due to Canadian withholding rules. And there's usually a indenture trustee, and in many cases located in New York. Some downside, of course, is there's dilution, and it's debt that needs to be repaid. And sometimes we even see warrant coverage attached to these convertible debt financings. For those seasoned issuers or the majors, high-yield debt financing has been really a trend over the last 2 years. Investor appetite for higher yields have driven this market. So it's, as you would suspect, high-yield bonds or notes, usually subordinated. The coupon yield will be dependent on the credit rating as well as other factors, including the profile of the company and historical financial performance. Maturity is usually more than 5 years, usually 8 to 10 years, but we're seeing shorter terms because of interest rate concerns, usually placed to QIBs under 144A. There's a comprehensive covenant package that's usually incurrence-based, which means basically a voluntary action on the part of the issuer will trigger a need to review these restricted covenants. And those restrictions usually cover things like borrowing, selling assets, or payments such as dividend payments in excess of a certain threshold amount. Those same restrictions apply to subsidiaries that are designated as restricted subsidiaries. They're usually offered under an offering memorandum, which is basically a liability document. Underwriters require 10b-5 letters and comfort letters. They're usually governed under New York law. An avenue that's pretty much unique to mining companies are streaming and royalty transactions. And we've seen growth in the business model of companies that are in the business of acquiring royalties and streamings transactions. And because of that, there's been increased competition in the space to acquire these types of instruments from mining companies that are producers. The structures have become more complex, and there are very complex structures out there. A royalty is fairly simple. It's basically a negotiated purchase of a NSR. You receive a fixed payment. Sometimes the NSRs are on sliding scales, depending on commodity prices, et cetera. And it burdens the land. It's something that is recorded on the actual property. Streaming transactions, sometimes called volumetric production payments, are negotiated purchases of production. Upfront payments are fixed. Sometimes they're milestone-based if the company is putting a property into production. Commodity pricing is always heavily negotiated. And there's sometimes an equity component, either through warrant coverage. Sometimes you'll see an equity investment as part of the streaming contract, so it's a bundled transaction. The nice thing about royalties and streaming transactions is generally the mining company maintains control over the operations. The other types of liquidity transactions, commodity forward purchases, which are basically gold or silver or copper forward sales agreements. They require basically a purchase of future productions, a delivery of commodities on specified intervals, upfront payments. There's usually a security interest and a warranty package that's associated with these. And there, of course, are risks and benefits associated with these types of transactions. The deliverables, the production, the pricing, accounting treatment. You might be able to move some of this off of your balance sheet. And then finally, we have non-traditional financing. And that takes the form of secured debt and convertible debt, and sometimes preferred shares. And these are generally done on a shorter-term basis and designed really to assist companies in putting their properties into production. Usually have a very high premium, very strict warranty and covenant packages, and sometimes equity and warrant coverage. The thing to note is they normally require repayment or dividend payments during the course of the maturity, and sometimes they're referred to as loan-to-own transactions. Finally, M&A transactions. As I indicated earlier, M&A activity has been down for the first half of 2012 and for several consecutive quarters. It's driven primarily by market uncertainty and a perception that some acquisitions in the past have been overvalued, which have led to significant asset write-downs. I won't cover this in detail, but basically it's important to remember that any time you are acquiring assets or companies for securities, you have to comply with the U.S. exemptions. The most common is Section 3810, which is a court-approved exemption. There's Rule 802 exemptions, very similar to 801, where the target company has fewer than 10% U.S. holders. And one interesting thing to note on Rule 802, this is also available to companies that are incorporated in the U.S. So as long as the target is a foreign company, you can rely on that rule. The U.S. does have tender offer rules. Those need to be complied with. And there may be other collateral or ancillary filings that you'll need to do, such as Hart-Scott-Rodino, CFIUS filings, and then the IRS has cost-basis accounting reporting for foreign companies issuing securities to U.S. taxpayers. With that concludes my section, and I'm going to turn the discussion over to Dan Miller, who will discuss exiting the U.S. markets.
Thanks, Ken. Hello, everybody. One of the questions that comes up as things become a little bit tougher out there is what happens if the company wants to leave the U.S. You're listed on a stock exchange, and you don't want to be, whether because you don't want to spend the money on the listing, you don't feel you're getting the benefit of it, or you no longer meet the listing requirements. What happens there, and what does it mean? Historically, the Amex, which is now the NYSE MKT exchange, is the most popular U.S. stock exchange for mining companies. And also historically, the exchange did not strictly enforce its listing requirements. It was quite rare for a company to be delisted or even receive notice of a deficiency if it's, for example, a stock price is too low. But as things get a little bit worse out there, and also since the New York Stock Exchange acquired Amex, they've been quite a bit more proactive in enforcing its rules, and companies are getting deficiency letters and are getting contacted by the stock exchange about getting back into compliance or potentially involuntarily delisted. It's important to know, though, that if you do get one of these letters or you get a call from Amex, they will work with you. They don't want to delist the company, so they will work with companies to come up with plans to get back in compliance. We have worked with many companies to get them back in compliance, and all hope is not lost if you get a letter from them. Next slide. But if, assuming you just want to leave voluntarily from a stock exchange, it's not difficult to do. It basically requires just board resolutions, written notice to the exchange, a press release that's filed with the SEC, and there's not much more to it. The SEC can reject the application. It generally doesn't do that. The application becomes effective 90 days after filing, but the process itself is not difficult to do. There is a big catch, though, which is that delisting from a U.S. stock exchange does not automatically eliminate the requirement to file SEC reports. In fact, it will likely be a minimum of 12 months before, and maybe longer, before SEC reporting can be terminated. The reason for this is that the way the U.S. securities laws work is that in order to be listed on an exchange, you have to be registered under the Securities Exchange Act of 1934. So delisting gets rid of the listing, but it does not get rid of the registration under the Securities Exchange Act. And you have to terminate that registration in addition to the listing in order to stop filing reports. So what do you have to do to stop filing SEC reports? Well, first of all of your registration statements that might be on file with the SEC have to be withdrawn, because if you have a registration statement, then obviously you have to keep filing reports. So that means all shelf registration statements. That could be a Form S8 for an option plan. It could be a regular shelf registration statement for public offerings or anything else out there. All that would have to be withdrawn from filing. Generally, the filing obligation remains for the entire year in which your registration statement is withdrawn. So if you're a December 31 company and you withdraw a registration statement January 31, you will have to keep filing reports in respect of that shelf filing for the rest of that calendar year. In addition, you have to meet one of the following tests. Fewer than 300 record shareholders worldwide, which are basically registered holders plus broker-dealers holding a street name. Or, if you qualify as a foreign issuer, 300 beneficial holders resident in the U.S. And then you look through CDS and DTC to the broker-dealer participants again for the record holder test. And a notice filing has to be made with the SEC. That test was a problem for a lot of foreign issuers historically. So a few years ago, the SEC realized that they wanted to make it a little bit easier for foreign issuers to get out of SEC reporting, so they adopted a new rule called Rule 12H6, which for companies with a very small U.S. market interest allows them to get out of the SEC even if they don't meet the test I just talked about. In order to qualify for Rule 12H6, you have to have been an SEC filer for 12 months and be current in your filings. You have to file one annual report with the SEC. Importantly, you cannot have sold securities in the U.S. in a public offering in the past 12 months. Private placements are okay, and dividend reinvestment plan filings are okay, but anything on a registration statement would not allow you to use this exemption for 12 months. And you have to be listed on a foreign stock exchange that constitutes, as a practical matter, the U.S. stock exchange cannot constitute more than 45% of your trading volume in a recent 12-month period, which is basically a 12-month period that ends no more than 60 days before the deregistration filing. So it is possible to deregister as long as you meet these as well as a few other things. Importantly, U.S. trading volume has to be less than 5% of the worldwide average daily trading volume for the securities during the same recent 12-month period. Now, that's important because if you delist from a stock exchange, then over time, your U.S. trading volume will presumably decline. However, it may not necessarily decline below 5% in a recent 12-month period for a while, possibly more than a year if an over-the-counter market develops and brokers start making a market on your securities, or if you list on an alternative exchange that doesn't require registration, such as the OTCQX exchange, something like that. So it's entirely possible that you could delist from a stock exchange and have SEC reporting for, as I said, at least a year, but potentially longer than a year. So you may be in this no man's land where you have all the costs of SEC registration without any of the benefits of a listing, although you would save the money of the listing fees, of course. If you qualify for Rule 12H6, you must issue a press release in the U.S. that discloses your intent to deregister, and then a notice filing must be made with the SEC. If you delist from a stock exchange, you're only eligible for Rule 12H6 12 months after the delisting, and again, but your volume has to be below 5% of your worldwide trading. Your duty to file SEC reports is immediately suspended upon filing of a notice under this rule, but it's not officially terminated for 90 days following the filing. The SEC is permitted to object to the filing during the 90-day period, but in normal circumstances it would be rare for them to do so. And if they do reject the filing, then within 60 days you need to do a catch-up filing containing everything that wasn't filed during the period before the rejection. It's really, really important to not just stop filing SEC reports. Sometimes issuers say, I'm done with the U.S., I'm delisting, I don't want to spend the time or money on SEC reports, I'm done with the U.S., I'm just going to stop filing. That's a big problem because the SEC can go to court and has been going to court to seek something called the Section 12J order, which basically is a court order that prohibits that company from ever doing anything in the U.S. again through a broker. They are increasingly seeking these orders. We've had several clients that have received notification of these court proceedings. And again, what it prohibits the U.S. broker from affecting any transaction in the issuer securities. That could mean capital raising through a broker transaction, but it could also mean executing a trade in your securities. So if there's a Section 12J order against the company, then there will never be another stock exchange listing for that company and never another brokered offering in the U.S. While these are difficult to get rid of, it's not completely impossible to eliminate them if the circumstances are right. So if you do get a notice, again, call us because we have successfully eliminated some of these notices, but certainly it is a much better situation not to get one in the first place. So if you haven't been filing reports or decide not to file reports, think about this because there's probably in the long run better, easier ways to do it. And now I'll turn it over to Bill and Wells for Mining and Natural Resources.
Hi, it's Kimberley Anderson again. I'd like to introduce Bill and Wells. Bill Prince, they are both located in our Salt Lake City office. Bill Prince is a partner and he's co-chair of our energy practice group, and Wells is an associate in our regulatory affairs group. They both practice in the area of natural resources development and environmental law, including all aspects of mineral acquisition, permitting, environmental compliance, joint venture development, and finance. So I am going to turn it over to Bill and Wells.
Thanks, Kimberly. This is Wells Parker and Bill Prince from Salt Lake City. We're going to talk this morning about some of the issues that parties need to be thinking about when conducting purchase and sale transactions in a down economy. And after we've discussed purchase and sale agreements and transactions, we'll discuss joint venture transactions. Over the last year, we've seen a significant increase in mining companies entering into joint ventures as an alternative means of pursuing and developing a project when financing is difficult to obtain. But first, we turn to purchase and sale transactions. One of the most common issues we discuss with our clients in purchase and sale transactions during an economic downtime is how the purchaser can structure its due diligence in particular with respect to title and real property diligence when there are limited budgets and time for due diligence. Mining projects in the United States generally consist of a variety of different types of property rights. There are generally federal unpatented mining claims, state and federal mining or mineral leases, private leases, fee leases, and occasionally fee interests. When conducting real property due diligence, the most complete method of review is to obtain a title opinion. Title opinions consist of a review of the applicable county records where record title is maintained, and a review of the title records maintained by an applicable land management agency. That would be agencies such as the BLM or a state leasing agency. The problem with title opinions is that they are very expensive and they are time-consuming to obtain. Oftentimes parties are dealing with limited due diligence budgets and they simply do not have the time and money to wait to obtain a title opinion. In such instances, more and more often we are seeing our clients turn to more limited and less expensive forms of review. And one of the most common methods is the review of electronic records. An electronic records review is a review of the records database that's maintained by the BLM to track ownership and status of mining claims and federal leases. And it's a review of the electronic databases maintained by many of the state leasing agencies with respect to state leases. An electronic records review is not a title opinion, and it does not track record title as registered in the county records. However, it generally takes a fraction of the time and cost that it would take to obtain a title opinion, and it can provide a useful summary of the ownership and status of mining claims and of state and federal leases according to the applicable regulatory agency. As part of the due diligence review for real property interests, it's critical during economic downtimes to confirm that the seller has continued to satisfy the maintenance obligations with respect to the real property interests at issue. Oftentimes, parties dealing with reduced staff during economic downtimes can miss filings or can make incomplete filings, and for some of the property interests, that can have rather dramatic consequences. For unpatented mining claims, it's important to confirm that the claimant has been making its annual maintenance payments, which are currently $140 per claim, and they're due on or before September 1st each year. For mining claims, the penalty for failing to make an annual maintenance payment is that the claims are declared void. We've worked on several transactions with a mining company has failed to properly maintain its claims, either by missing payments or filing incomplete maintenance filings, and as a result, the claims were considered void and had to be relocated. For state, federal, and private leases, there are generally annual rentals that have to be paid. Occasionally, there are advanced royalty payments, and then there are royalties based on production. For state and federal leases, confirmation of payment can often be made online on the federal or state electronic databases. For private leases, the only real way to confirm payment is through verifying payment through the records of the lessee or the lessor. For fee interest, it's important to confirm that the owner has been making the required property tax payments, which can often be verified online on the applicable county assessor's website. Failure to properly pay property tax can result in tax liens and a potential tax foreclosure action against the properties. Next slide, please.
In a similar fashion, and this is Bill Prince speaking, in a similar fashion, difficult markets essentially mean a poor economy and thus budget restrictions. And because the mining industry is a highly regulated industry in the United States, particularly on the environmental reclamation side, sometimes budget restraints can lead to potential under or non-compliance issues. This is particularly true where you have complex permitting situations. And for mining projects, all aspects of the project, air, water, soil, reclamation, uses of hazardous materials are all regulated and all important. Unfortunately, in difficult times, one of the tendencies is to part of a transaction is to skip a standard due diligence review on compliance for environmental matters, and that's probably the opposite direction of where a company ought to go. So I want to spend just a few minutes here talking about some key aspects of environmental due diligence in a transaction in a downtime that may need require greater focus by the parties. Key to this is a determination or evaluation of the compliance of the obligations for the environmental and reclamation for the mine. And in this sense, if there's a lack of ability to carry out due diligence or a lack of funds, it could lead to the inability to identify what are going to be problems going forward with the mining project. In a recent transaction that we were involved in, the seller, it was clear after doing some work that the seller had sort of stepped back from maintaining a permit, or at least prosecuting a permit in such a way that it would be it would cover the operations of the mining plan as had been proposed in the seller's activities. And so when the buyer stepped in on this, not only did they have to deal with a permit that turned out to be not in compliance with existing obligations under the applicable statutes and laws, it also did not cover and could not cover plan changes and operations that the buyer had intended for the mine property once it was purchased. And that led to its inability to move quickly once the property was acquired towards new operations. And it also put it in a position that, not in compliance, it had to deal with costs to come into compliance, for one, which had to be negotiated with the regulatory agencies, but also with penalties that the regulatory agency applied to the now current and new owner for not operating in compliance. All of those not only delayed the operation of the property moving forward, but obviously cost more money than would have been required, and put a difficult time for the new owner in taking on new operations that it was planning to do. A third aspect that is often overlooked is this notion of citizen and potential citizen suits for a project that is being purchased, acquired, or joint ventured. In particular, in the United States, this is a major consideration. And we found that a lot of citizen suits are now focusing principally either on the activity itself or sometimes just on location. For the activity in the past years, things like coal and uranium have triggered a number of different citizen suits just by the nature of the activity, the mining activity. And for location, oftentimes if the property is located in a wilderness area, near a wilderness area, an area that's been withdrawn, in particular scenic areas, areas that have difficulty with air quality issues, citizen suits are filed not particularly focused on any one operator, but focused on the fact that they're located in a particular area. So this probably requires more caution in looking at this issue, which can be determined either through due diligence questionnaires or possibly even through an internet search on the types of suits that have been filed or being prosecuted. Finally, obviously a big concern to parties are known and unknown contamination. Unknown contamination or even known legacy issues is a big issue in the United States under the Superfund Act and state parallel statutes. But I would suggest that a parallel issue to this is also long-term or perpetual reclamation obligations that come with mining properties. And recently we've seen that many of these properties that have these environmental reclamation obligations, there's not been due diligence done as to the regulatory body's initiative to require longer-term or perpetual reclamation obligations to the properties. And without knowing that going into the transaction, you can end up being burdened by a significant long-term obligation to manage the property even after you're done with operations. This would lead us also into what happens in transactions as to permit transfers, and Wells will spend a few minutes walking through that.
One of the key issues that we often see appear in purchase and sale transactions of mining projects, which causes delays or problems in the transaction, and in particular in economic downtimes when parties are trying to race through a transaction on a limited budget, is the regulatory approval process for a permit transfer. Most mining projects have several permits issued by a variety of different regulatory agencies. In order to successfully conclude the transaction, the new owner of the property must acquire all of the operating permits for the property. Each property and each regulatory agency has its own permit transfer process. Permit transfers often require advance consent and approval of the applicable regulatory agency. And each agency has its own set of regulations governing the transfer or change of control of a license or permit. As part of the process, parties are often required to post new financial assurances or reclamation bonds. They're required to sign assumption agreements or to complete transfer forms that are specific to each particular permit and each particular agency. Certain permits require that the proposed transfer be announced to the public and that interested parties be allowed to submit public comments or request a hearing with respect to the transfer. For projects that have a history of third-party environmental or landowner challenges, a permit transfer that allows for public comment can cause significant delays and can allow third parties to intervene and delay the closing of the proposed transaction. The need for permit transfer is likely to be determined by the structure of the acquisition. Most permits require permit transfer filing if the permittee or licensee changes. However, significantly fewer permits require filings in change of control transactions, which do not involve a change of the actual licensee or permittee. So if parties have concerns about third-party intervention in a transaction, they may opt to structure the transaction in a manner as to avoid triggering public comment and hearing requirements for a permit transfer by pursuing a stock membership or entity-level transaction in which the actual permittee under the permit or license does not change. Now we're going to turn and discuss briefly joint venture transactions. Next slide, please.
Can we have the next slide? We'd like to move forward then on the. We talked a little about some of the limitations that are caused by difficult markets. We'd like to talk about some of the advantages that are out there. The next slide will detail some of that, but we want to focus on joint ventures and the notion that joint venturing projects allow party to, through collaborative effort, share the risk, profit, and control of properties and take advantage of others' desire to participate when in fact the economics may not be there. Our next slide would identify what some of these advantages are, and let me walk through them. So we could go to the slide after this one here. One of the key issues here is that it allows a party to get access to capital and expertise. That means that if you're unable to get financing or you have trouble with bankability in terms of what the property is in the project, bringing in another party may assist in that and may give you that enhancement to bankability. It may also give you the ability to acquire technology and certainly know-how if the party that comes into the transaction has the expertise to add to that. There's a sharing of risks, obviously, between the parties when you go in, but there is an advantage to parties where you have difficulties in either retaining projects because of the economic difficulties of paying maintenance fees or just keeping the project active, or ability to operate projects that you would not otherwise operate. For example, a company whose core activities relate to precious minerals, maybe gold or silver, but otherwise might have a copper project or some other related project, but is not using that project or cannot maintain that project. Through joint venturing, might be able to bring in a partner that would allow them to stay involved in that copper project. With respect to retaining the project, if you're not otherwise able to maintain it, for example, we've worked with companies that have a sometimes broad interest in many projects across the United States, but their principal area of expertise might be uranium. In order to maintain those other properties, they'll bring in a joint venture party to share the risks and share the ability to keep those going forward. There are other opportunities here, sometimes to gain an interest into a geographic area or a commodity market are available to parties at joint venture. And there is sometimes an ability to hedge prices or supply concerns if you can venture with a party that is otherwise a consumer partner. Now, we'll spend a few minutes just talking about the nature of the available joint venture structures.
Next slide, please. In mining transactions, there are principally two types of joint ventures. There's contractual or unincorporated joint ventures, and there are entity joint ventures in which the joint venture parties jointly form an LLC or a corporation. For many years throughout the 80s and the early 90s, the principal form of joint venture was the contractual joint venture, in which parties are bound by a joint venture agreement but do not form a separate legal entity. Contractual joint ventures provide parties with the greatest flexibility, Unlike an entity joint venture, contractual joint ventures are governed largely by common law and are not subject to the statutory restrictions and limitations applicable to corporations and LLCs. As a result, parties can craft the joint venture agreement to achieve an efficient tax treatment and to provide for a much simplified process for winding up and distributing assets. In addition, contractual joint ventures are easier and less costly to maintain because the parties do not have to manage and maintain a separate legal entity. The principal disadvantages of contractual or unincorporated joint ventures is that the parties, depending on the applicable state law, often have fiduciary or other duties to each other that can make it difficult to effectively manage the joint venture. In addition, contractual joint ventures do not provide the members with the protection from liability that may be available in entity joint ventures. JV partners are generally jointly and severally liable for the joint venture and therefore face unlimited potential liability. Contractual joint ventures can also pose challenges with financing and contracting with third parties such as landowners and regulatory agencies. Since there's not an independent entity, the joint venture parties are often required to sign the contracts and agreements. Next slide, please. Over the last 15 years or so, the mining industry in the United States has seen a significant increase in the use of entity joint ventures, principally using LLCs. In 1998, the Rocky Mountain Mineral Law Foundation published the Form 5A LLC model form of joint venture agreement, and since its publication, LLC joint ventures have become much more prevalent. The particular advantage of an LLC joint venture over a contractual joint venture is a decrease in the participant's exposure to liability of the entity. In addition, the parties have reduced duties to one another as members of an LLC rather than contractual partners in a joint venture. The existence of a separate legal entity often eases the process of receiving financing and contracting with third parties. In addition, the ability to create separate classes of interest allow the parties flexibilities when developing projects. We've worked on several joint ventures that include multiple projects in which the parties have created separate classes of membership interest for each project so that the parties' ownership and rights of distribution of production can be different for each individual project. The principal disadvantages of the LLC or entity joint venture are lack of flexibility in dealing with control and ownership and other issues that are addressed in the applicable state law statutes. LLC and entity JVs can generally be more expensive to manage since the parties have to manage a separate legal entity, make annual filings, and maintain a registered agent. In addition, there are generally statutory restrictions and limitations on the winding up process and the process of dissolving the JV, and it can be a more cumbersome process than in a contractual joint venture. Next slide, please.
Well, the last slide simply focuses on the fact that the complexity of various joint ventures as to defaults and remedies is a two-edged sword, and that is it's advantageous to its various members to the extent they're able to use those rights to move the venture along, but it's also an issue that should be looked at carefully if you're stepping into a venture in times when there may have been either dilution or a loss of minority or voting rights because of failure to participate at the full level that you could participate in. In particular, emphasis should be put on a review as to the rights of the parties under rights of first refusal, buy-sell rights, or put or call rights, which could all affect a party that's coming into a joint venture who might want to make sure that their particular interests are protected once they step into the venture. And that wraps up our review of our materials, and we'll pass it off now to Michael Droke.
All right. Let me introduce my partner, Michael Droke, who's in our labor and employment group in Seattle. And he practices up and down the West Coast. He's in both Seattle and Palo Alto. And I think he's actually admitted in most of the West Coast. But before we start with Mike, I just want to reiterate the New York CLE number. The code number is QXK269. So I'm going to turn it over to Mike.
So one of the things that happens with a joint venture is often you'll have redundancies in positions, and obviously in distressed times, any company's looking to decrease variable costs, and one of the fastest ways to do that is to look at potential headcount reduction. And so many clients want to reduce their overall headcount, And I want to begin by really giving you kind of the conclusion of a couple of key points to take away. The first is that it's very important to start about 90 days before the reduction in force. As you'll see with regards to the Federal WARN Act, there are some requirements to give notices that are triggered potentially. And so having counsel review and corporate review of the reduction in force is really important about 90 days or so in advance of the reduction. Second is that there are some regulations that do apply in a different way in a multi-person termination program, and so being aware of those requirements is important. Now, first thing to do is to scrub your existing policies, procedures, and contracts to determine if there's anything that could potentially apply. Many companies have layoff policies or severance policies that would be, for example, in their employee handbook. Many companies, in particular in the mining industry, have employment agreements, contractor agreements, individual contractor agreements, and the like that often contain severance or notice of termination requirements that could impose a de facto severance program. Likewise, if you have a union contract, what's called a collective bargaining agreement, that's important. And it's also important to review your corporate agreements, such as purchase and sale of land or subsidiaries, in which, in some cases, the purchaser has agreed for a period of time to offer severance to anybody who's terminated after that change of control. So pulling out all of the affected policies is going to be important because the company will be held accountable to any promises it's made to the employees. Now, if severance is offered, employers typically will want to get a release of claims. A release of claim agreement would cut out any liability for the termination or other issues such as wage and hour or harassment that may have occurred during the course of employment. Now, release agreements for individuals over 40 are covered by something called the Older Worker Benefit Protection Act, or OWBPA. Generally speaking, even for terminating an individual who's over 40, there are some specific requirements that are imposed on the release in order to have it be valid, and those requirements are listed here on slide 40. Those include being in writing, clear, mentioning the ADEA, Age Discrimination and Employment Act. The employee needs to be given 21 days to consider the release, and then upon signing, whether that's immediately or on the 21st day, 7 days to revoke essentially a lemon law. Now, in a group or class termination program, there are two significant changes. First is, instead of 21 days to consider the release, the individuals over 40 need to be given 45 days to consider the release. And second, there's some basic information that needs to be provided to the individuals who are subject to the release program. And that basic information involves two things. First, a description of who's being offered the release, typically something fairly neutral, such as individuals terminated during the month of September 2013. And second, the job titles and ages of anybody within the group who was under consideration, and whether they either were or were not given a severance offer. In other words, they either were or were not terminated as part of the termination program. And so we have an example here. This comes straight from the Department of Labor's website. In this example, as you see in the mechanic assembler 2 position, there are a series of 6 individuals. Age range is 22 to 51. Of those, a third of those were terminated, and all those terminated were over 40. And so that would give the employee some indication that there might possibly be age discrimination for the mechanic assembler 2 position, given that the majority, in fact all of the people who were terminated there, were over the age of 40. Now notice that one person who's age 51 was retained, and that would have obviously cut against the inference of discrimination. Now, the Older Worker Benefit Protection Act group or class requirements would only apply if there is, in fact, a group termination program that's looked at on an individual basis. Typically, you'll be consulting with counsel, and they'll advise you as to whether the termination program exists. Likewise, it's important to be attending to this issue because the Older Worker Benefit Protection Act is a law that has strict compliance. That means that if there's any error in the release agreement, the employee gets to keep the money and sue you anyway. Obviously, not an outcome anyone would want. Now, in larger scale companies, as Ken described, the more mature and larger operators, anyone who has over 100 employees that are working on a full-time, regular basis could be subject to the Federal WARN Act. The Federal WARN Act is triggered anytime there's either a plant or location closing or a mass layoff that affects a large number of employees, typically 50 employees or more and a third of the workforce at that location or greater. In those situations, the employer is required to give 60 days notice to all affected employees, including seasonal employees with a reasonable expectation of recall. That notice, as I described, must be given at least 60 calendar days before the employment loss or the normal date of recall, and sent to a variety of individuals, not just the employee, but also some state and local agencies and potential union representatives if there's a union in place. Similarly, if you do have a union in place, it's important to be paying attention to the National Labor Relations Act. The NLRA requires an employer to bargain collectively with the union on any issue involving wages, hours, or terms and conditions of employment. Obviously, that would include plant closings or mass layoffs. Now, in the area of a mass layoff or a plant closing, if it would be possible to decrease wages such that the plant would not need to close or the layoff would not need to occur, then the employer may need to bargain over the fact of deciding to lay off in the first place. Either way, and that's rare by the way, either way, the employer still has the duty to bargain over the effects of a layoff, in particular severance policies. Now, once the layoff has happened, there's some issues to just be paying attention to. First, the law doesn't stop applying just because the employees have been terminated. For employers of 20 or more employees, COBRA could apply. There may be workers' compensation insurance claims. You'd want to look into that. Likewise, unemployment insurance often will apply in a layoff situation. And then finally, looking at assets and protection of intellectual property is important, as employees obviously sense of loyalty to their company drops significantly after the layoff. And then finally, if you are continuing to operate, I strongly advise employers to be paying attention to morale issues and essentially re-recruiting employees after the reduction in force. Many employers give financial incentives to work for 6 or 12 months after a reduction in force because they know, like we observe, that recruiters are out recruiting significantly for your workforce. So we do encourage employers to look at re-recruitment of employees, existing employees, and keeping them on board to the maximum extent possible. So sometimes even those kind of efforts aren't sufficient, and you need to find other protections for the assets and look in bankruptcy. And to that, I turn to Annette Jarvis, a partner in our bankruptcy group.
All right, I'd like to introduce Annette. Annette is actually partner in charge of the transactions department firm-wide and also a member of our bankruptcy and financial restructuring group, and she works out of Salt Lake City and Denver. So we're running short on time, so I'm going to cut her bio short, and Annette, take it away.
All right, and we may go a couple of minutes late since we started a few minutes late. No discussion of an economic downturn in an industry is complete without talking about insolvency or bankruptcy laws. And I'm going to briefly describe the U.S. bankruptcy laws that are applicable to cross-border businesses. These are Chapter 15, Chapter 11, and Chapter 7. For a foreign-based company in financial trouble, there may be a reason for using one or more of these chapters, and that would be if they either have a subsidiary in the United States, if they have property they need to protect in the United States, or if there's litigation that they either need to defend or stay in the United States, or litigation that they need to bring into the United States. Let me start first with a discussion of retention of insolvency counsel. And the reason why this is important is that the United States bankruptcy laws have very, very strict conflict rules when it comes to counsel for debtors. So it may be that pre-bankruptcy counsel may be disqualified from representing a company once it goes into bankruptcy. U.S. law requires that debtors' counsel may not hold or represent an interest adverse to the debtor's estate and must be disinterested. The disinterestedness standard is basically a standard that says there can be no connections that would basically influence a counsel in any way that might be adverse to a debtor in possession's fiduciary duties to its creditors and other constituencies in a case. So, for example, if a counsel had represented the company's officers or directors individually, that would be a disqualification from representing the debtor in bankruptcy, the company in bankruptcy. And among other things, this also means that a debtor's counsel cannot be a creditor of the debtor. So if the law firm is owed money at the time of the filing, they either have to waive that claim or they cannot represent the debtor in bankruptcy. They can also not have received a potential preference. That is a term under U.S. bankruptcy law that refers to the payment out of the ordinary course of money to a creditor within 90 days of the bankruptcy filing. Now, it's important also to recognize that the earlier insolvency counsel is retained, the more options a company has. It's very, very common that companies do not retain bankruptcy counsel until they have a cash flow crisis. And at that point in time, usually their only option is to try to stabilize the business and sell the business. A much earlier, at the earliest sign of financial distress, if bankruptcy counsel is hired, there are often many other options for the company. Next slide. Let me just summarize Chapter 15. Chapter 15 is the cross-border proceeding in the United States. It's an option to allow for concurrent proceedings in the United States and in the home country. Now, it is not a full-fledged bankruptcy proceeding. It only provides assistance in the United States to the foreign representative in a foreign insolvency proceeding, or the ability for that representative to appear in concurrent U.S. cases. That may be litigation cases, or it may be in another bankruptcy case in the United States. Typically, a Chapter 15 is commenced to preserve property in the United States, or because there is concurrent litigation going on in the United States, either in state or federal courts, or in another bankruptcy proceeding. When a Chapter 15 is filed, the automatic stay automatically comes into effect, and this is a stay that allows breathing space for the debtor. It protects property of the debtor so that creditors may not go after that property. It also stays any litigation that is currently going forward and stays the commencement of any new litigation against the debtor. Avoidance actions, which I'll get to in a minute, are not available in a Chapter 15. These are reach-back provisions. They are only available if a Chapter 11 or a Chapter 7 is filed. Next slide. Let me give you a brief overview of Chapter 11 in the United States. This is a proceeding that most operating businesses would use if filing bankruptcy in the United States. In this case, the debtor's management remains in control. There is no trustee or any kind of oversight administrator appointed in the United States. The debtor's professionals are paid as priority claims from the unsecured assets of the estate. So that would include both counsel and financial advisors, other advisors as well. An official committee of unsecured creditors is normally appointed in a Chapter 11 case to oversee the process. They have standing to be heard in anything that goes on in the estate. The committee is usually comprised of the 7 largest creditors, unless the United States Trustee's Office believes that a better mix would be had by inviting other creditors to participate. The automatic stay that I described does go into effect when a Chapter 11 case is filed. There are a lot of options that are allowed to companies in Chapter 11 cases. The use of cash collateral, even if a lender does not consent, can be had in a Chapter 11 case if certain statutory requirements are met. The same thing applies to DIP loans, or debtor in possession loans, where maybe outside of a bankruptcy, the lenders will not lend to a debtor. There are options, even sometimes allowing the priming of existing loans in a bankruptcy that may give more options for financing in a Chapter 11 case that would not be available outside of a Chapter 11 case. Next slide. Another important option given in a Chapter 11 case is the assumption and assignment or rejection of executory contracts. So this would allow a contract, an important contract that might not be able to be cured and assumed outside of bankruptcy, to be cured under statutory provisions. It also allows for the rejection of burdensome contracts, which means those contracts are able to be breached, and the damages are pre-petition claims which are not paid in 100 cents dollars. It also allows for the assumption and assignment of valuable contracts, even sometimes over anti-assignment clauses in those contracts. It also allows for the sale of property free and clear of liens, which is very important when you need lender consent that you can't obtain, or you have title problems or other issues, and it will often make the property more valuable in being sold in this fashion. You can pursue avoidance actions in Chapter 11 cases. I referred to those before. Those are generally reach-back provisions. There are two types. Generally, fraudulent conveyances or transfers where property is brought back into the estate where it had been transferred out for less than a reasonably equivalent value under circumstances such as insolvency or inadequate capitalization within a certain period of time. There are also preference actions, which is the allowance of recovery of payments made preferentially to creditors within 90 days or to insiders within a year, that can be brought back into the estate to equalize payments to all creditors. The way a Chapter 11 case is concluded is through a plan of reorganization. This is a very complex contract. You have to meet a bunch of statutory requirements, but it allows the entity to either be sold or to move forward. Distributions under a confirmed plan, there are certain statutory priorities that are taken into consideration, but on creditor votes and on meeting other statutory requirements, that can be changed in a Chapter 11. Next slide. Then lastly, let me give you a brief overview of Chapter 7. In this case, a trustee is automatically appointed upon the filing of a Chapter 7. That trustee takes total control of the business, all records, all property, bank accounts, etc., and their job is to liquidate the business. The automatic stay does come into effect when a Chapter 7 is filed. While a trustee can normally operate a business temporarily in a Chapter 7 to maximize recovery to creditors, the business is usually shut down, as most trustees do not want to operate businesses. The assets are then sold, and in Chapter 7 cases, avoidance actions are always pursued. In Chapter 11 cases with critical vendors and the like, they can be not be pursued as part of a plan of reorganization. All of that is much more flexible in an 11 than in the 7. The avoidance actions are always pursued, and the distributions are by the statutory priorities. There's no way to alter them as there is in a Chapter 11. And that concludes just a brief overview of our bankruptcy provisions in the United States that would affect cross-border companies.
Thank you, Annette. That is going to conclude today's webinar. And you can submit, as a reminder, you can submit your questions directly to a presenter. Email addresses are down below, or to DorseyU@Dorsey.com, and then the questions received will be addressed by email. So again, we want to thank you for attending. And one more reminder is that Dorsey attorneys in various groups, including people on here, will frequently write articles and so on, and publications and updates. And you can sign up for those at www.Dorsey.com. And thank you again, and we hope to do another one of these in the future, and hope you can attend. Thank you.
Thank you. Please stand by.